So we'll now look at the various ways of mitigating counterparty credit risk. Now, the easiest and the best thing to do is to not give the loan, or in other words, deal only with high quality counterparties. If you've already entered agreements, then the following methods can be used to reduce your credit risk or mitigate your credit risk. So you can opt for cross-product netting. So we'll explain netting with an example. So let's assume counterparty A and counterparty B are trading amongst themselves with various instruments. In some instrument, counterparty A has gained $25 million and correspondingly counterparty B has lost $25 million. Similarly, in another trade, A has lost $17 million while counterparty B has gained $17 million. If we consider these two trades, what is the credit exposure at the moment of counterparty A? In the first trade, he is having a gain of $25 million, hence his credit exposure is a positive $25 million. If the counterparty B defaults, there will be a loss of $25 million. In trade B, A has no credit risk as he is the loser, he is the credit risk. So if we do not do any netting, that is, if we take the exposures as is, then if counterparty B defaults, then A will have to pay his $25 million and he will not receive the $17 million that he was supposed to. So with no netting, counterparty's A's exposure would be $25 million. So netting essentially means that in case of a default, all contracts will be netted off and settled. That is, the net obligation of A and B will be settled. All contracts or all trades will be immediately terminated. So with netting, the net exposure of counterparty A would only be $8 million as he was to receive 25 and pay 17 million to B. Similarly, for counterparty B, without any netting, he has a positive exposure of $17 million. However, if counterparty A defaults, it will probably be a good thing at the moment for counterparty B because he has to pay 25 and receive 17. So his credit exposure per se is zero. With netting, he will be a credit exposure or he will be a credit risk to the tune of 8 million for counterparty A. In closeout netting, all contracts are immediately closed in the case of default. So if default happens on any one contract, then all contracts between A and B will be immediately closed and settled. Other agreements or terms that you can get into to mitigate credit risk would be bilateral agreements, standardized terms so that there's not much confusion and there's a clear-cut understanding of the two counterparties as to what has to be delivered and what is the price, etc. A lot of time credit risk comes not because of the ability to pay, but because of the willingness to pay or because there is some dispute in the terms, etc. So make sure that your agreements are watertight and you have standardized terms that can easily be explained and accepted. If the assets are transferred to special purpose vehicles, then again, reclaiming your claim from these SPVs is generally easier, and isolation of the assets also helps in pricing and subsequent resale if needed. Collateralization is a good method. So if you're dealing with a counterparty or you've given him a loan or there is some exposure, you should take something as collateral. Keep some cash or keep some other assets. Diversify your credit risk. That is, do not entirely be concentrated just to one counterparty. If you've given 1,000 different loans of $1 million, then we've studied earlier that is a much lower credit risk than one loan of $1,000 million. Finally, credit risk will be much lower if you're trading on exchanges where there are centralized clearing houses who do margining and who take various steps to ensure that none of the participants default, or even if they do default, they have sufficient margin money so as to honor the obligations. So once again, netting involves combining cash flows from different contracts into a single amount, as we just saw. Closeout netting happens if the counterparty defaults. So when a default happens, all contracts are clubbed together and netted off. Bilateral netting is limited to only two entities. Multilateral netting, on the other hand, happens between multiple counterparties, and it usually requires the help of a central counterparty. So there will be a central counterparty, that is an exchange or a clearinghouse, who will monitor, or to whom each of the other participants will report their obligations and inflows. So A and B will both report their claims to this central counterparty. So let's say A owes some money to B, B owes some money to A, $10, $20. What this central counterparty will then do is net the exposures of each one of them. For a simple example, assume that A owes $10 to B, B owes $10 to C, and C again owes $10 to A. In such a case, the central counterparty will conclude that no payments have to be exchanged amongst anybody. So basically, all market participants report their expected inflows and outflows to the central counterparty. The central counterparty will then accept payments from people whom payment is due and disburse the payments to people who are to receive payment. So let's assume after the netting, the net liability of A comes out to be $100 and the net gain of C comes out to be plus $100. So A will give $100 to the central counterparty, who in turn will transfer it to C. So that's the concept of multilateral netting. Now, positive correlation between mark-to-market values will have lower netting benefits as compared to negative correlations. That is, with perfect positive correlation provides the least netting benefit, and perfect negative correlation provides the most benefit. We'll understand this with an example. So let's assume that I have two trades with the counterparty, and both trades have a strong positive correlation. That is, when trade 1 is in the money, trade 2 will also be in the money. Or when trade 1 is out of the money, trade 2 is also out of the money. Please note, in such a case, that is in scenario 1 and in scenario 3, there will not be much netting benefit. So even without netting, my exposure is $20 on the two trades. And even if I net, there is no netting that is actually going to happen because I'm positive exposure in both. So even with netting, the exposure remains $20. So the netting benefit in this case is 0. In scenario 2, where there is actually a perfect negative correlation or a high negative correlation, we see when trade 1 is in the money, trade 2 is out of the money. Hence now we will realize significant netting benefits. So the total exposure without any netting would be $5. That is the gain that I have. Remember, exposure is always the positive part of the trade. And with netting, the exposure becomes 0 because in case of any default, I will not receive my $5, but I will not pay the $5 that was due from me as well. So the netting benefit is $5. Again, in the third case where there's high positive correlation, that is both are negative at the same time, without any netting also there is no exposure because I am the credit exposure, or I have to make the payment. And even with netting there is no credit exposure. So you can calculate expected exposure. That is, if all these scenarios were equally likely, we would do 1 by 3 into 20 plus 1 by 3 into 5. And similarly with netting, if all the scenarios were equally likely, you will get the expected exposure as 6.7 and the expected netting benefit as 1.7, since there will be no netting benefit in the first scenario and the third scenario. Similarly, you can verify that in the case where there are high negative correlations between the various trades, so one trade is positive, the other trade is negative. Again, when one trade is negative, the other trade is positive. Only scenario 2 has having a positive correlation. In both other scenarios, we have a negative correlation. Now, the netting factor can be defined as the expected positive exposure with netting divided by the expected positive exposure without any netting. Please note that the expected positive exposure with netting will always be less than the expected positive exposure without any netting. The highest value of this ratio will be equal to 1, that is when there is no netting benefit at all. In the best case, this ratio will be 0, that is the potential exposure with netting comes down to 0, or the ratio becomes 0%. If you have n different exposures and the average correlation amongst our exposures is rho average, then the netting factor can also be defined as, or it can be derived as, the square root of n plus n into n minus 1 into the average correlation upon n. So when rho is equal to 0, this formula will become square root of n upon n, that is approximately equal to 1 upon root n. The netting factor will be minimized when rho is minus 1 and it will be maximized when rho is equal to plus 1. Please verify that if rho is equal to plus 1, then the netting factor will be equal to 1 or 100%. The numerator will also be n divided by n. So in the examples we studied, we can derive the netting factor as the potential exposure, rather the positive exposure with netting divided by the positive exposure with no netting, that is 10 upon 13.3, and similarly 6.7 with netting divided by 8.3 without any netting would be the netting factor. So remember, it's the expected positive exposure with netting divided by the expected positive exposure with no netting. Let's understand that how would the following scenarios impact the netting factor. So if you've added a 4-year swap pair position to a 5-year swap pair position, so you're already a fixed rate pair and you've also added, or you've added another pair position. So in another swap, you are further the fixed rate pair. Do you think there'll be any netting benefit, or do you think the netting factor will go down in such a case? No, because there'll be a very high positive correlation between the two instruments. So as one gains, the other will also gain. As one loses, the other will also lose. You will not derive any benefit, or there will be no improvement in the netting factor. Yes, if you add a 4-year interest rate swap receiver position to a 5-year swap pair position, then there'll be a big netting benefit. So you are plus C and you add a minus C. So we're denoting plus C as a pair and hence minus C would be a receiver. So in such a case, there would be a big netting benefit, because as one position would be in the money, another would be significantly out of the money. There's only a marginal gap between the two, hence there will be a significant reduction in the netting factor or significant netting benefits in example 2. If a 5-year cross-currency swap is added to a 5-year swap pair position. So again, you are a pair. We're denoting the pair as a positive. Normally we don't, we do it the other way around. But anyways, for understanding, it's a pair position and we've added a 5-year cross-currency swap. So let's assume to begin with that this is a pair swap. That is, we are the pair in our currency. In such a case, the correlation with high, because we are also a fixed rate pair in the 5-year swap. However, the correlation will not be perfect, or it will not be as bad as example 1, because there will be some diversification benefit or some lack of correlation coming because of this cross currency position. So again, there may be some netting benefit, that is when the 5-year swap pair is in a gain, our first position may be in a loss, and vice versa. Please note that is what we need. We need a negative correlation or a difference in movements for netting to provide any benefit. If this was a 5-year cross-currency receiver swap, that is we are receiving fixed payments in our currency, then the benefit would have been marginally even more higher because we are also a fixed rate pair in our currency in the other swap. So again, not as good as example 2, but definitely better than example 1. So remember, in qualitative questions on netting factor, you basically have to take a judgment on how much is the correlation between the two instruments. The more negative the correlation, the more will be the netting benefits, the lower will be the netting factor. The expected positive exposure without netting and the expected positive exposure with netting obtained from Monte Carlo simulations are 110,000 and 95670. Compute the netting factor. Straightforward. It will be the potential exposure with netting divided by the potential or rather the positive exposure without netting, that is 110,000. So this comes out to be about 0.87. So some benefit but not much from netting that is happening in this question. Now the total expected exposure would be a combination of the marginal expected exposures for each trade. So if there are n trades, then the expected exposure total would be the sum of the expected exposures from each trade. Please note, the marginal expected exposure is the additional exposure that a new trade would be bringing into our position. If the new position has a very low correlation to the existing portfolio or to the existing set of trades, then the marginal expected exposure will be lower with netting as against the marginal expected exposure without netting. So we'll understand with an example. Suppose the expected exposure without netting and the marginal expected exposure with netting are calculating using Monte Carlo simulations. The results of the two trades are presented in figure 9. Compute the total expected exposure. So independently, trade 1 and trade 2 have an expected positive exposure to the tune of 6.5% of their notional values. However, when we add them to our portfolio that already has some existing exposures, the expected exposure with netting comes out to be only about 3.45% for trade 1, and the expected exposure with netting comes out to be 5.84% with trade 2. So trade 2 has a high positive correlation with our existing portfolio, hence not much netting benefit, whereas trade 1 probably has a low correlation with our existing portfolio, hence more netting benefit and lower expected exposure with netting. So the total expected exposure would be the sum of the marginal expected exposures, and that will be 3.45 plus 5.84, that is 9.29%. So please note that netting will be beneficial only if there is a positive exposure and a negative exposure. Otherwise, as we have seen, netting will make no difference. So netting arrangements are beneficial as long as trading instruments can have negative values during their lives. Netting for trades with the possibility of only positive exposures is generally not beneficial. So if I'm only long options, that is my only position in the portfolio, then netting will make no difference, because I can never have a negative value, or I have already paid the premium that had to be paid. There is nothing that I have to pay henceforth. If of course there is some possibility of future negative mark to market values in some other trades, then maybe netting can help. So for netting to be beneficial, we need to have some negative values that will offset our positive exposures. So we'll now study collateralization in a little more detail. So collateralization involves the party with negative exposure posting collateral in the form of cash or securities or some other assets to the party with positive exposure. So it can include various assets, various securities, commercial papers, letters of credit, or even equity. The most common type of collateral generally is cash paid by the person who is in a loss to the person who is in a gain. Some terms relating to collateralization that we must remember is first the threshold. So threshold is the level of exposure below which collateral will not be called and represents a level of uncollateralized exposure. So if I'm only in a gain of $10, then I won't call for collateral. The minimum gain has to be, let's say, $1,000, or the minimum gain has to be $1 million, depending on the comfort and the level of the transaction. So threshold is the minimum level of exposure below which collateral will not be called. Another term called independent amount, also known as initial margin, is the collateral that is posted upfront and is independent of any subsequent collateralization. So this is referred to like the margin money. So regardless of whether you are in a gain or a loss, both counterparties generally put up $10 of margin money or collateral. So this can be thought of as a level of over collateralization, or more the initial margin money, less is the counterparty credit risk, because to some extent there is collateral already been provided, even though you may not have had any gain yet. So we studied threshold, we studied the independent amount. Minimum transfer amount represents the smallest amount of collateral that can be transferred. So let's assume our threshold was $1,000. That is, whenever the profit goes above $1,000, collateral has to be posted. Now, if it becomes 1,001, a $1 collateral will not be asked for. So the minimum amount of collateral, or the minimum transfer amount, is kept so that the operational workforce or operational load is reduced. That is, frequent transfers of $1 or $2 don't happen. The minimum value of the collateral should at least be $100. So the minimum transfer amount is to reduce the operational workload of frequent transfers for small amounts. Please note, however, that the threshold and the minimum transfer amount are additive. That is, the exposure must exceed the sum of both before a collateral call can be made. That is, if the minimum transfer amount is $100 and the threshold is $1,000, then a collateral call will first happen at $1,100. Or if the exposure becomes $1,200, then a $200 collateral call can be made. Minimum transfer amounts are typically tied to credit ratings, and higher ratings correspond to higher amounts. So if you have a good credit rating, then the minimum transfer amount we can keep high, if you have a bad credit rating, then we will even accept low minimum transfer amounts. Even $10 we will accept because we want the money soon. The next term is referred to as a haircut, and that is a discount given to the value of the posted collateral, with cash having the lowest discount, because if you've put in cash, then the money is received. And if you put riskier securities as collateral, then the haircut that we will apply will be higher, given that when we go out selling the asset, we may not get the price that we were assuming it to be. Substitution refers to substituting a collateral. So let's say I had given you $100 of asset A as collateral. For some reason, the counterparty needs asset A back. So he takes back A and gives us an asset B of the same value, or it substitutes collateral A with collateral B. So substitution refers to posting an equivalent value of some other eligible collateral. Rehypothecation refers to transferring posted collateral to some other counterparty as collateral. So I received $100 of collateral from one counterparty, and for my transaction I further give this collateral to another counterparty, or I rehypothecate it. So this collateral I again gave as collateral to counterparty B. So counterparty C gave me collateral, and I pass it on as collateral for my transaction to counterparty B. Please note, this will doubly increase your credit risk. So if counterparty B doesn't refuse or doesn't give your collateral back, then you lose this collateral, and then you'll have to source it and give it back to collateral C or to counterparty C as well, because you have to return the collateral once the payment has been made, or the position is closed. A very important concept is that of the remargin period. So this is the period from which a collateral call takes place to when the collateral is actually delivered. Now, we can imagine that if we place a call today, the collateral will not come to us instantly. There will be some minimum period, 2-3 days, 5 days, within which the counterparty will source the collateral and provide us the collateral. So the remargin period can be from 5 days to 10 days to 15 days, depending on the various circumstances and depending on various factors. Generally speaking, for OTC derivatives, for the valuation call or the margin call to go out takes about 2 days. For repurchase agreements, that happens instantly. Another 1 day of time is given for receiving the collateral, 2 days in settlement for OTC derivatives, and 1 day for repos. A 3-day grace period is normally awarded to the counterparty to put up the collateral. No such grace period in the case of repos. And then it may take another 2 days for us to liquidate or close out the position if needed, 1 day in the case of repos. You don't have to remember these values, but just understand that Basel II says a minimum 10 days of remargin period should be accounted for. And in the case of repos, at least 5 days should be accounted for. OTC derivatives, 10 days in your calculations. What this may do is that within the remargin period, if the exposure goes up further and then the counterparty defaults, we may not even have sufficient collateral so as to be able to make good our positions. Or in the 10 days that the collateral actually comes, more collateral may be needed, or we may need to send another collateral call, and if that doesn't come, we may have a credit loss. So once again, exposure is the positive value of a transaction with a counterparty. Expected exposure is the average value of the positive values at any point in time. We studied in credit exposure that if we assume that the underlying will follow a normal distribution, or our instrument follows a normal distribution, then the expected exposure would be the expected value of the positive side of the curve. With the normal distribution assumption, this will come out to be 1 over square root of 2 pi into the standard deviation of the exposure, or the standard deviation of this distribution, into the square root of t. The potential future exposure is what the mark-to-market exposure might be at some point in the future. So potentially we may have no profit at all, or potentially we may have a large profit and hence a large credit exposure. So expected exposure is the expected value of these positive values. Please note, the x-axis is the extent of the profit or the positive value, and the y-axis is the probability. So a large probability of a very small gain and a small probability of a very large gain. So small probability of a large gain. Potential future exposure is calculated with the help of a confidence interval. So with a 95% confidence interval, the potential future exposure would be 1.645 into the standard deviation into square root of Tm. With a 99% level, it's possible that it may be 2.33 times the standard deviation. Now the reason that we need to study the remargining period well is because our expected exposure, and more importantly the potential future exposure, may deviate significantly within this remargining period. So if sigma E is the volatility of the exposure or the volatility of our instrument, Tm is the remargin frequency. Please note, the volatility will be in years, so even Tm should be calculated in years. If it's 10 days, then it will be 10 upon 365 years. So the expected exposure within the remargining period can additionally be to the tune of, or rather is expected to be to the tune of 0.4 into the standard deviation of the exposure into square root of Tm, and potentially can be much higher. The risk that this presents is that the collateral that we may receive may not be sufficient to cover our entire gains, or we may still have some further credit loss if our position comes further in the money. Some criticisms of the calculation that we presented before include that this calculation assumes full collateralization. That is, we are first of all assuming that the collateral that is coming is exactly equal to the value of our position. If anyways the collateral that was coming was slightly lower, then the exposure can be even higher than what we have presented. It doesn't consider wrong way risks. That is, again, exposure can be higher if, when we have a positive position, the counterparty has a negative impact. Wrong way exposures are exposures which affect us and the counterparty differently. So when it affects us positively, it affects the counterparty negatively. A right way exposure is an exposure wherein we are also impacted positively and our counterparty is also impacted positively. So if the exposures are wrong way, then again the possibility of default increases and credit risk is generally higher. The liquidity of the collateral should be taken into account. Liquidation risks should be taken into account. So when we go out selling the collateral, we may not get the full value, or we may need to apply a haircut. Hence, the calculation earlier assumes that the collateral is not going to be volatile, or the collateral is in cash. Hence, we only considered the volatility of our exposure or of our instrument. However, in reality, you may need to account for the uncertainty of the collateral volatility as well in computing the various exposures. Finally, please understand that a counterparty that receives collateral has a positive mark-to-market value, and a counterparty that posts collateral has a negative mark-to-market exposure. Factors that affect the calculation of the exposure profile while taking collateral into account, that is, if I'm computing my exposure and I'm knocking off collateral. So if I have an exposure of $100 and a collateral of $50, then my net exposure will be $50. While I'm doing this calculation, I must be mindful of the following facts. First, there will be or there could be a remargin period. As we studied, this is the time between the margin or the collateral call and the time that we actually receive the collateral, so this may create some additional exposure. There is a minimum transfer amount and a threshold. So if the minimum transfer amount has not yet been reached, then to that extent there will be an exposure. The threshold itself is an exposure. So this is the minimum amount of our exposure after which a collateral call would be made. So if $100 is the threshold and $10 is the minimum transfer amount, then at least $110 will be the value of our exposure before which we will even call the collateral. If there is a good independent amount, then that may reduce the exposure. This is like the initial margin. And rounding off may also create a small amount of exposure depending on the direction of the rounding. So if instead of asking for $10.6 of collateral, I ask for $10, then that will increase the exposure. If I ask for $11, then that will reduce the collateral, or that will reduce the exposure. Like we studied in the previous slide, the uncertainty of the collateral or the changes in the value of the collateral may also need to be modeled. While modeling the collateral, we must understand the terms of the collateral agreement, that is, how can we sell it, how quickly can it be liquidated, etc. The risk of increased exposure between margin calls. So if the collateral goes down in value, and then by the time more collateral comes, there would be an increased exposure. We should also take into account the path dependency of the collateral. So the path that interest rates follow or that the markets follow, how does that impact the value of the collateral should also be taken into account while modeling the collateral. So that was about mitigating credit risk. We studied the concepts of netting, collateralization, and other theories to reduce the credit risk from our counterparties. We'll study about credit value adjustment and pricing credit risk a little more in the coming review. Thanks a lot and see you next time.